Good evening, everyone. I welcome you all to this EAC webinar. I'm joined by Chairman Expert Advisory Committee and immediate past President CA Dr. Devashish Mitra ji and Vice Chairman CA Piyush Thajar ji and our esteemed speakers CA Vivek Nevatia ji, CA Sandeep Shah ji and CA Jayant Gokhale ji will be joining us soon. Now I invite our chairman to express and give opening remarks.
Thank you very much. The lady who is speaking is Parul Gupta. She is the secretary of this expert advisory committee, right? And good evening, everybody. Vice chairman of this committee, Piyush Charya, and many of you who are from Bombay and now he's a council member from all over India have seen him, and he's doing such a fine work in the expert advisory committee. We have Mr. S.N. Gupta, who is a joint director, who is also amidst us. You see, Gupta ji not only looks after the expert advisory committee. Yeah, Gupta ji, can we have your so that everybody can see you there? And the two ladies also can come this side so that they can also, the Khushbu also can come this side. Then you see, Gupta ji, not only this thing, those of us who have been following Accounting Standards Board, he's been doing fantastic work. And then, of course, we have Khushbu Bansal, the Assistant Secretary, doing so much of work. Many of the opinions that you see now are initially drafted by her and Parul Gupta, and then you see it comes to the committee. And then, of course, we have Priti Lakheria, the project associate, and Priyanka Jalan, the project associate, there with us, and Vishnu Kumar, he's the UDC, who is helping us. And I say all these names because, you see, the expert advisory committee does so much of good work, and these people who are sitting in the office, all of them are chartered accountants, they do such fantastic work. And of course, on the screen, you see the two luminaries from the profession who are part of the expert advisory committee and who do so much of hard work, sharing their knowledge. Sandeep Shah ji and Vivek Nevatia ji. And Jayant Gokhale is going to join us. Sandeep Shah ji had a small operation, but still he's here. Is he trying to share his knowledge with us? Thank you very much for your presence. Those of us who are watching me speak, expert advisory committee, you will note, has not been the most popular or the most extrovert of committees. You see, those are only the big corporates. They make use. They send matters for opinions before us, and then some of the matters are so intricate that you see it is very difficult even for the committee to come to a conclusion. But nowadays, not nowadays. This committee has been there since 1975, and you see, we have been working very, very hard to see that the opinions that we give, both on accounts and audit, are of great use to those who seek these opinions. And these opinions are sought by even the regulators. And we do everything possible. That discussions sometimes are so intense. And as a chairman, let me tell you, it is very difficult to come to a unanimous conclusion on the opinions. But we try our best to have unanimous opinions. And we have some of the best accounting brains in this committee. Now, many of you might be wanting to know, about the background of the expert advisory committee. As I said, unlike ASV, it may not be the most popular, the committees, because we work sometimes as a backroom boy. So, I would just like to, introduce you to the committee. I would request Khushbu to just, start the PPT. Have a look at this. By the way, just the other day, I believe, if my memory serves me right, on the 25th of June, we have just celebrated doing such good work since 1975. Can we have the next slide? Look at the way the committee has evolved. ICI, as we all know, is celebrating 75 years of its existence. Established in 1949, and the 250th meeting was held on June 26th to 2023. And when the 200th meeting was held in December 2016, I had just come into the council and I was the vice chairman of this committee. And you see, I have seen the committee grow and evolve over a period of time. Right. So you see, 75 years of the ICI and this committee has done human service for the profession. Can you have the next slide, please? 1975, as I said, that was the year when this committee was formed, right? 3rd December 1975. And this committee, you see, has a huge and great legacy, just like the Institute of Chartered Accountants of India. It has a huge legacy, this committee. Can we have the next one? So the role is, as you have seen, adoption of best accounting practices, financial reporting, converting the accounting challenges faced by the members into opportunities, taking a stand on various complex issues on accounting and auditing. And you see, you have seen the CAG, Securities and Exchange Board of India, and so many chartered accountants and corporates, they take advantage of the expertise of this committee. Can we have the next one, please? These are the terms of reference, self-explanatory. I'm not going to repeat. So you see, the opinions, we have given about 1,600 opinions till now, right? So you see, opinions are, so we are very proud of the opinions that we give. So this is the first opinion that we have given. If you see the date, it is December 31st, 1975. Immediately after this committee was formed, that was the first opinion that we gave on December 31st, 1975. And since then, you see the number of opinions that we have given have been only increasing. Can you have the next one? Look at the number of opinions that we have given. 72 opinions in 1975. And it is about 1,600 opinions till now. Those of us who think that, EAC, if you give a matter for opinion, it might take 4 or 5 months for it to give opinions. Nowadays, we are very fast, use technology, use best of the brains. You will find an opinion being given in about 2 months' time. So that is how fast we work. That is how fast we work. And then you can see the sector-wise analysis of the recent EAC opinions. This could be of use to you. I'll request Khushbu to pause at this stage so that those of us who are having a look at it can see the kind of sectors that we have covered, from the banking and finance to the infrastructure to the manufacturing, mining, so many areas, power, so many areas that we have covered over a period of time. If you can we have the next one, Khushbu? Yes. And this is, accounting standards. If you see in the initial stages, that was the early stages of Ind AS. 2016-17, we used to have all opinions based on AS. But as time has progressed, the opinions are all now based on Ind AS. Have you seen, look at the 2022-23 figure. Almost 80% on about 90% of the opinions are based on Ind AS. So Ind AS, here you see in this committee, and all these chartered accountants were sitting here, and with the vice chairman, leading the charge. If we are all trying to grapple and attain expertise on Ind AS, because unless we know Ind AS very well, it is very difficult to come to a conclusion on these various intricate matters that are brought before the committee. Can you have the next one, please? Even on the Ind AS, you see the areas on which we have given, first of all, assets, and then consolidation, and then expenses, and then financial instruments. You see revenue, presentation, then other Ind AS. So many, almost all the Ind AS we have covered. And mind you, when a matter is referred to the committee for opinion, it is referred when the person who is referring the matter feels that the matter is so intricate that they could not come to a conclusion themselves. So this committee has to use its expertise and give an opinion. So you see, it's very difficult for this committee to do so. right? But over a period of time, as I said, as you have seen, 1975, we have always tried to strive towards excellence in giving our opinions. Can we go for the next one? How many of you have seen the compendium of opinions? You see, we have issued 42 volumes of compendium of opinions. And these compendium of opinions, sometimes when you are stuck, you don't know what to do. And now audit, in the last issue of the Chartered Accountant, one of the past president has quoted me saying that audit is a serious business. Right. So you see, now when you have accounting and auditing as serious business, it is very important that you have a look at this compendium of opinions. We have issued 42 volumes till date, right? So have a look at them. It will be of great use to you. And then those of us who want to have a good search engine to have a look at it, look at the next slide that we are showing you. Yeah, this is search application. Use it. We are not saying that you go for the hard copies. Hard copies, of course, a person like me, I would love to have a look at the hard copies, but you can always look at the search option, the search engine, and have a look at the opinions. I would strongly suggest that you should always refer to the opinions, the 42 volumes that we have got. It is of great use to all of us, to all the professionals. Right? So can we go for the next one? If you look at the Chartered Accountant magazine, you'll find that in every issue of the magazine, we cover one opinion. Have a look at that. You see, you'll find them to be very interesting. Let me tell you, over a period of time, in the initial stages, when I was not so much into India, I was more into corporate laws. I would like to think that I would never used to read these opinions that are given in Chartered Accountant. But over the period of time, since 2016, when I came into the council and I was the vice chairman, started reading these opinions. And most importantly, I've started enjoying the intricacies of the issues involved and how this committee has come to a conclusion. Right? So I would suggest to all of you that not only read these opinions, but enjoy the way the opinions have been given. Can you have the next one? Right. Thank you very much for your kind presence here, for your patience till now. Because let me tell you, this is, at the EAC, we have been a bit introverted in the sense that, we have been giving these opinions, but now we have decided to come out in the open and share with you the opinions that we have given. And Sandeep ji, Vivek, Jain Gokhale ji, they will dissect about 6 issues, right? There are 6. They will dissect about 6 issues that are there. And my only advice to you, just enjoy. That unstructured, 2 unstructured hours will come to you. Don't worry about it. But just enjoy the way it has been done. And you'll find that, the opinions that have been given, the kind of work that has been done. So to all of you, I wish, a very happy learning. And let me tell you, every month, the Expert Advisory Committee will organize these kind of programs, and we look forward to your kind presence. Have a great evening and a very enjoyable learning experience. With these words, may I now request the Vice Chairman of this committee, Piyush Chajir, to introduce the speakers. Piyush, please.
Thank you very much, Chairman, sir. The Honorable CA Dr. Devashish Mitra, the immediate past president also. I'm blessed to be having him as a chairman, who himself is an expert of accounting standards and corporate law. And it is such a great learning experience to be with him. I think so. This has been my first year of the council, and I'm blessed to you have as a chairman and also as a first president of ICA for me, basically. The speaker and the panelists for the day, Sandeep Bhai Shah and Jain Gokhale ji, moderator Vivek Nevatia, team of Expert Advisory Committee, all welcome you, all the participants. Very good evening, all of you. It's my pleasure to introduce the panelist and the moderator for today. First, I will introduce CA Sandeep Shah, who is on the screen. Jain Gokhale would be joining in some time, I believe. CA Sandeep Shah is a chartered accountant having over 39 years of experience. He comes from Mumbai and he's the senior most partner of Anisha and Company, a very well-known firm, which itself is expert in accounts, corporate laws, taxation, international taxation, and more than 100 chartered accountants over there under him. He has been a member of expert advisory committee. Most importantly, when you have to speak on expert advisory committee's opinions, obviously I think so we cannot have a better panelist than him, because he has also been indulged into discussions, thread by line to line reading whenever the expert advisory committee is actually discussing on the opinions. He has been also the member of the several council committees of accounting standard board, auditing and assurance standard boards, India's implementation committee, and many other groups for guidance. So that is what is important. It is. I'm sure all the participants will be benefited by his expertise. As the committee name says, expert advisory committee. Obviously, I need not tell again and repeat that the panelists and the moderator are experts, and they have been part of the expert advisory committee. The other panelists who would be joining and who would be also deliberating on the various opinions which have been selected by the team and the panelist and moderator is Jayant Gokhale. Again, a 40 years of experience, again from Mumbai. Both the panelists are from Mumbai, from where I hail from, and that's why it excites me also. He's been also a Central Council member for 12 years. And as a Central Council member, he was also a chairman of Expert Advisory Committee and various other committees, technical committees such as FRRB. He was also a PRB chairman, and he has been contributing a lot. Before being a Central Council member, he was a regional council chairman of WRC, and he has been a prolific speaker at various forums. We hear him for the institute platforms, BCS platforms, and various other bodies. He has been continuous speaker for all the expert subjects, basically. He has been the independent director of the various corporates and has been also on the committees of SEBI and the Ministry of the Finance. So he has also a very great background of technical. I'm sure the participants will be benefited by it. Vivek Nevatia, of course, a moderator. I can say my friend also. I worked together him as a joint auditor, and I know his expertise with a 17 years experience. A very young person, but having an expert as if he has also an experience of 40 years, definitely. So I've been seeing him closely. Again, associated with the EAC, giving his opinions, giving his intelligence to the various subjects since last more than 4 years continuously. Thank you very much, all the panelists and Vivek, for joining us for such a short. We had just discussed about this last week, and I'm very, very much thankful and honored that you all of three accepted our invitation in such a short notice and to prepare for such opinions, which itself takes such a time. We have been discussing this yesterday also, that how we should go about it, and I really appreciate your concern for it. So I welcome you. My small request before I actually throw open the mic and give it charge to Vivek, my small request is why this seminar and why this webinar has been organized. It's not important. There may be 6 opinions which we have selected. Some of the participants may find that it is not interesting to me. It may be a very specific subject which you may not have encountered in your professional life, or you may feel, and that's why it may not be interesting to you. It's not important what is subject. It's very important that what were the facts. How did the expert advisory committee interpreted the various provisions? This will help you professionally. Even if you do not encounter such subjects at your professional level, but whenever some queries comes, questions comes, you will get an idea that how do experts look at it? How do they interpret the accounting standards? That will help you in discharging your assurance functions very well. So again, a warm welcome. Good evening to you. And with this, now I would request moderator Vivek Nevatia to please take this session forward. Thank you very much.
Thank you, everyone. A very good evening to the chairman, Mr. Debashish Mitra, the immediate past president also, and the present chairman of the committee. Piyush Bhai, I know him so well. We are indeed privileged to be part of this committee, to be part of this committee and be present as part of this webinar to discuss about the intricate issues, 6 opinions which we will be discussing, some final points of the Ind AS. A very wonderful efforts being taken by the office of the EAC, who have actually identified the issues which would be discussed and discussed with, and we, the panelists and all of us have discussed in detail each of the issues to be discussed and what would be the fine points in each of the opinions that would be relevant for the audience at large. I think it's not just about the principles of these six opinions. I think what you can carry home would be the principles of each of the Ind AS that we would be discussing as part of these opinions. I would just present my screen and start off with the first case study. So with respect to the first case study, this is about accounting for securitization arrangement and investments in pass-through certificate securities. A very interesting issue which we deal with in case of an NBFC when we are, even when the banks would follow Ind AS, they would possibly deal with a lot of these securitization arrangements. And the facts of this case would be similar to the kind of securitization arrangements which an NBFC would probably enter into. And an NBFC which would follow Ind AS would require to deal with the accounting of this kind of a securitization arrangement. The brief facts of this case are as follows. The company is basically a systematically important non-banking NBFC and which is engaged in lending business. What it had done during the year was it sold 471 crores worth of principal outstanding receivables for a purchase consideration at par to a special purpose vehicle. So in a securitization arrangement, what happens normally is the receivables which are there in the form of loans outstanding are assigned or sold for a consideration to a special purpose vehicle, which is a trust generally. And this trust was created in March 2021 and was created and settled by the trustee under the securitization route. What the trust did was, in consideration of the sale of these receivables worth 471 crores, it issued 4716 number of pass-through certificates of face value of rupees 10 lakhs each to the investors and the company. And what the company did was it had subscribed to 7% of the principal outstanding. That is, out of 471 crores, 33 crores worth of consideration was paid by the NBFC. The rest was subscribed by the other investors. So the investors and the company made the payment to the trust, and the trust then paid 471 crores worth of consideration for the sale of receivables to the NBFC. So this 7% investment was in stipulation of the minimum retention requirement, which is provided by the RBI. So the company what the company also acted as a servicing agent, and what it was responsible was to pass on the receivables, pass on the monthly collections which it would receive against the receivables. The trust would then, the company would then pass on to the trust. Trust will then settle the obligations to the investors and debit the balance to the company on satisfaction of the monthly obligations. So this is a graphical representation of the securitization arrangement. What was done, if you look at this graph, the company actually sold 471 crores of principal outstanding for purchase consideration at a par. The company also subscribed 7% of the principal outstanding in PTCs or issued by the P Trust. The investor, including company, was subscribed to the other investors subscribed to the balance 93% of the PTCs. The company received 471 crores of purchase consideration from P Trust for securitization of the receivables. And the company also operated as the service agent to pass on the monthly collections of the underlying securitized receivables. So effectively what happened as a result of the structure was, what the company believed based on this structure was, this receivables sold by the securitization did not meet the derecognition criteria of substantial transfer of all risks and reward under Ind AS 109. So this was the contention put forth by the company to the expert advisory committee. So what the contention was, that these receivables would not meet the derecognition criteria, and therefore these receivables would therefore continue to be shown as part of the assets in the financial statements of the NBFC. The sale consideration received from the trust would be treated as borrowings and disclosed as a separate line item in the financial statements under the head borrowings other than debt securities. So since these receivables were not meeting the derecognition criteria, the sale consideration received was treated as borrowings and disclosed under the line item borrowings. Now, in the securitization arrangement, there is a credit enhancement also given by the NBFC, which is in the form of fixed deposit collateral, which is used for the purpose of improving the credit rating of the PTC, which is issued, to ensure that investors get attracted to the trust to invest in the PTC issued by the trust. So this credit enhancement, which is given in the form of fixed deposit with banks, was disclosed as part of bank balances other than cash and cash equivalents, with a suitable note to the effect. Now, the question was whether this investments in PTCs, which is issued by the trust, which is invested by the company, NBFC concerned, was netted off against the securitization borrowings in the financial statements with an appropriate note. So the investments which were made to the extent of 7% by the NBFC was netted off with the borrowings disclosed as part of the liability, under which was nothing but the consideration received on sale of the receivables concerned. Now, the question which arose here, whether the existing disclosure for PTCs, which was disclosed as net of securitization borrowing, is in line with Ind AS 109 and complies with the basic principle of substance over form. So this was the query which was put forth by the company to the expert advisory committee, and with this, the issues which were there were discussed. And I would like now Sandeep ji to discuss the issues which were discussed before the EAC and arrive at the view which was in accordance with this standard. Sandeep ji.
Thank you, Vivek, and thank you, Chairman, Vice Chairman, for your opening remarks and words of appreciation for the panelists and the moderator. Thank you so much, and office, of course, for this opportunity. Considering the fact that we have to discuss 6 opinions, I will straight come to the point. And I'll pick up the point which Vice Chairman said, that it is not just about the aspect of a question, but it is about the understanding the industry, the finer nuances out of it, what are the matters which are considered, and finally, what is the conclusion which is received. Theoretically, somebody may come back and say, it's such a small point. You have a borrowing, you have an investment, whether to net off or not to net off. I look at my schedule 3 because it's NBFC, so we look at division 3 and then probably come to a conclusion that what is the logical approach to the answer. And if the matter was so simple, then I don't think the matter would have come to the expert advisory committee, because there are obviously in every accounting opinion, the interpretation of what the relevant standards, including the basis of conclusion, sometimes because basis of conclusion sometimes becomes also a very important aspect to understand that what was the philosophy behind how the main standards were drawn. And one thing for the benefit of the readers, I always will say that EAC opinions are extremely structured opinions. You can always know that what does the company talk about, what is it has analyzed, what is the background leading to this kind of questions, what is the contention of in brief about the company, maybe in some cases the regulator, sometimes in case of the auditor, if there is a difference of opinion, and then thereafter, what does the committee consider and what does the final opinion come back. And in my experience, I can tell you that what you see as sometimes 8, 9, 14 pages of committee opinion, the underlying documents which the committee members is reviewing, in one of the cases that we were reviewing 600 pages. So you can imagine that if you have to do justice to the opinion, you cannot just come back and say that, okay, we will just briefly go around and give the opinion. That's only from a point of view, because Sir did mention that from 4 months to 2 months, it's not about laziness, it's about execute and meticulousness about the opinion is what is the point which I want to make in my opening remarks. Second part, which I always recommend, is to look at what are the ancillary issues which the committee always brings out when it comes to the points considered, because those are what we call our shootouts. They are not relevant for the opinion under consideration, but those are relevant points if somebody wants to holistically look at this entire issue on the securitization. As we know that in a securitization, the special purpose vehicle in India generally is a trust formed under the Indian Trust Act. So it has got its own existence under the Indian Trust Act. it's a different issue on the legal aspect, that whether is it only a legal entity or not, but we are not, that's not the point. The second part, of course, which therefore comes in also from an overview, the ancillary points, is that whether do you need to consolidate, do you not need to consolidate the SPV, is the second aspect of the issues sometimes which are highlighted. Third part is Vivek mentioned about the fact that there was a right to take over the PTCs if the outstanding amount falls below 10%. So therefore, there is what we call is a call and put option, and therefore, what is the relevance of that? Plus, he mentioned about the fact that you are going to act as an agent for the purposes of collecting the money and handing over. Now, whether that constitutes an independent service or does not constitute an independent services are also matters for the purposes of deliberation. And of course, it is accepted on facts that the derecognition criteria were not met. So that was not an issue before the consideration. So now, therefore, what are the, when one looks at logically, you have in a margin money, in a letter of credit, you have DRSR in case of the loan for interest receivable. The question is that whether does it partake the same characteristics of that of a pure deposit, or is it just merely an instrument, and therefore in sum and substance you get 100, you have got 7. Now it can be 7, it can be 15, it can be 12, it can be 25, whatever it may be. But in substance, the question is that what have you borrowed as a final net consideration in your hand? From a banking perspective, you invested 7, others invested 93, you got your 100. That's from a banking perspective. So what was the item which the institute, the committee had to therefore look for? That what are the relevant standard first, which tells me as to how does this investment in PTC, whether does it satisfy the definition of a financial instrument, point number one. And even if it is a financial instrument, whether on a presentation, whether is it to be netted off or not. As we know that currently Schedule 3 guidance does not have this as a definitive guidance. So therefore, from Schedule 3, you will not be able to draw any conclusion. Like we have, like our Schedule 3 when it came to the liability on the lease, while there was no standard whether it's a financial or a non-financial liability, Schedule 3 came out with the answer. But for this, our Division 3 does not have that. So the relevant paragraph which the committee had to therefore explore, and for the benefit of the members, you may look at a B for Bombay 3214, 3.2.14, which is one of the relevant paragraph which had to look for. And here what it said, and I will just read it quickly, to the extent that a transfer of a financial asset does not qualify for derecognition, which is the case in our study, the transferor's contractual rights or obligation related to the transfer are not accounted for separately as derivatives. If recognizing both the derivative and either the transferred asset or the liability arising from the transfer would result in recognizing the same rights or obligation twice. For example, a call option retained by the transferor may prevent a transfer of financial assets from being accounted for as a sale. In that case, the call option is not separately recognized as a derivative asset. So the fundamental principle is that you cannot have a bloated balance sheet on the liability side and a bloated balance sheet on an asset side if that asset is not going to behave any differently from the liability which you have. And considering the principle of 3.2.14, an analogy was drawn, because this is the closest item to come back and say that do you show your asset and liability on both the gross side or not. It was eventually with the reference of para 3.2.14, it came to a conclusion that it would be appropriate only to show 93, which was the net consideration which you received, because you don't have any special, it's not even a marketable instrument. Your PTCs are not even marketable instruments, and therefore it was just to comply with the regulatory requirement that you had to put the MRR. Had there been no regulatory requirement from Reserve Bank of India, probably this investment would not have been there at all. So that is the part from the basis of conclusion which the committee put in. Interestingly, while there was no question asked that what are the disclosure requirements which are there when it comes to such assets and liabilities which are not derecognized, because one is to give a note, but the second part is to also therefore to come back and say, and therefore the institute, the council, the committee did in its wisdom bring out two relevant points, and which is out of Ind AS 107 disclosure, para 42A2H is what has been written. And I specifically would like, for the benefit of those members who have probably not encountered application of securitization in its professional experience, what does the 107 para 42 D and E, which deals with the securitization which are not derecognized. If I may want to, just for the benefit of the members, this is available from the implementation examples, illustrative examples of the IFRS, and also from our institute has the tie-up, so we can also through the link see this. So what this example is 7IG on the top part, what it is looking at, because your assets which are securitized can be under FVTPL, it can be under amortized cost, or it could be through under FEOCI. So because each of their behaviors will be very different. So the question was that of the carrying amount of the assets which are subject matter of securitization, what are the trading assets and what are the derivatives. Now in this particular case, they had picked up the example of a trading asset and a derivative. In our case, it can be just a loan portfolio, but whatever could be the different characteristics. So those are the items which they had in the case of the FETPL, they had the trading asset plus derivative. In the amortized cost, that the mortgages and consumer loans, and in the FEOCI, they had equity instruments. And then below that came the carrying amount of associated liability, that for each of these line item, what is my borrowing which I have not which I'm carrying forward in my balance sheet. So for somebody to understand the difference between the asset, which is the carrying value, and what is the associated liability which I'm doing. So in this case, this would be the breakup of your 93 rupees. The second important part of, no, just below that, the second important part for this liability is where they have recourse only to transferred assets, because we came back and said that you could have a securitization with enhancement, could be without enhancement. So in cases there was no enhancement, and if there was only a recourse to the transferred asset, then what would have been the fair value assets, and what was the fair value of the asset liabilities, and what is therefore the net position, because this is going to be important for the holders to understand what is the naked position in their books. So this is an important aspect from the both the NBFC which is securitized, as well as for those who probably may be owning this. This is one part of the 42D. So I wanted to give, and the next is what we spoke about, the fact that since there was a 7% call and put option, and the question is that how do you define that pot and pull option, because you did decide that for the purposes of not bloating the balance sheet, this will be given, this will not be treated. Here comes the question that what was your continuing involvement, and what are the periods, whether you have the return put options, you have purchase call options, you have security lendings, and then each of the timelines. So between these two, it enables the understanding of how the securitization has worked. And with that, I believe that it's one of the, pre application of NBFC, we only had the RBI guidelines, which, give out very, very exhaustive, detailed disclosure of what we do in securitization. But this opinion would be of a great example, not only for securitization, but also to understand as a concept. Thank you.
Thank you, Sandeepji. Sandeepji, just to take a step back, and certain one question which I would ask you here is, what is the kind of diversity that you see in respect of accounting for these kind of PTCs?
I think one part which we see is about the fact that so two or three areas. One area which is certainly there is that whether when you have a financial instruments which are at amortized cost and you have very regular securitization happening, which means that you're technically selling those assets. Now, whether they get de-recognized or not recognized is a separate aspect. But one part of the question which comes in from 107 and 113 is that how does the amortized test? Because eventually when you do for amortized test, it is supposed to be STTP compliance. And that does not mean that only because it is amortized cost and STTP, therefore you must continue to hold and burn entire money. But there are specific guidelines which gets associated as to what necessitated the securitization. This is one part of the aspect. The second part of the variation which we see is in consolidation, that whether when you are holding the PTC, because whether that trust is revocable, irrevocable, whether secondary transfers are permitted, not permitted. So those are the second areas of divergence which we see, and of course the disclosure under 42D is something which we do find that is what is not. Some attention needs to be paid to that as well.
Jain sir, any quick thoughts on this first case study? Sir, you're muted, sir.
Yeah. Sorry, first of all, I'm late and I have been running around. I've reached back to my office from where I left to participate from home. I've had a massive problem. So honestly, I have not heard Sandeep at this moment. I was busy setting up everything. So at the moment, no comments. Maybe in the later part, in the other queries, maybe I could add something.
No problem, sir. No problems. So just to, I think, summarize the discussions here, I think what Mr. Sandeep pointed out was very, very relevant. So what the company presently was doing was setting off of the borrowings with the PTC that was invested. So the PTC, the investment in pass-through certificates to the extent of 7%, which was made as per the MRR requirement of Reserve Bank, was netted off against the borrowings by the company. So what EAC discussed and looked at the principles put in Ind AS 109 and discussed the principles of B 3.2.14, wherein if I have a continuing involvement to the extent of 7%, which is just a requirement of securitization, wherein I invest in the pass-through certificates to the extent of 7% and I get the money back, the setting of principles should not apply. What I should recognize is only to the extent of 93%, which I receive. And that 93% should be recognized by the company, assuming the derecognition criteria has not been met. So the EAC opined that what the company was following as setting off of the PTC with the borrowings would not be probably appropriate. What would be more appropriate is to recognize only the amount to the extent of 93%. And of course, the disclosures which are there would be very, very relevant. I think most of us do miss out on the disclosures, which are very important and ensure that the transparency is maintained when it comes to the right disclosures. Thank you, Sandeep ji, for the wonderful insight. Coming to the next case study, I think when Mr. Dr. Mitra pointed out with the issues which are there, in the one of the major Ind AS wherein the expert advisory committee has opined on is on Ind AS on property, plant and equipment. And I think most of us, even though the standard on property, plant and equipment has been there for quite some time, we still face issues when it comes to how do we treat expenditure relating to indirect expenses incurred on construction of project. And I think this EAC opinion actually deals with a lot of expenses which are incurred in the course of construction, and it gives valuable guidance on how each of those indirect expenses should be treated for the purpose of whether it should form part of capitalization of property, plant and equipment. So coming to the facts of this very interesting case study, this company was in the business of designing, developing, implementing, financing, operating and maintaining RRTS, Regional Rapid Transit System. I think when you look at these facts, I think what is important here is the company was engaged in construction of a RRTS project. This company, since the construction was going on, did not have any operating income. And what the company did was it was deploying its entire manpower for the sole purpose of construction of this RRTS. Even the MD and other directors were actively involved in the construction related activities of the project. A very, very relevant point to note here. The company also opened site offices and the corporate office, which was either taken on rent or was being constructed. The site office, the purpose of the site office was to house the civil electrical departments, and also those employees were interacting with the contractors and supervising the construction of the project. Corporate house had multiple departments. It ranged from design department, track department, the electrical, the traction, the electromechanical, moving on to IT infrastructure, finance, HR, administration, company secretariat. So there were multiple departments which were housed in the corporate office. The company had 5 full-time directors, who were designated as MD, Director Finance, Director Projects, Director System, Operation, and Electrical and Rolling Stock. So what the company said was the direct departments at serial number 1 to 10 and above till IT infrastructure were exclusively engaged in the construction of projects. The employees working in finance department were majorly engaged in project related activities, which were bid evaluation, selection of contractors and suppliers, project monitoring, and payments. Out of 118 employees who were there in the corporate office, 107 were working for the departments 1 to 10. So what the company did before coming to the EAC, it made a list of all the expenses which were being incurred in the course of the construction. And it specified the accounting policy which it was following for each of those expenses. What I will do is, Jen sir, if you agree, I think we can take up each of the expenses one by one, so that I think the flow is better. If that is okay, or should we just continue?
Maybe you can take a few for the reason that the principles will be the same. So broadly, we'll be discussing the principle rather than each individual expense. Perhaps you can go a couple of slides into that, and then I can take over. Then we can take over.
Perfect, sir. So with respect to the first category of expense was in respect of salaries and wages. So what the company said was these salaries and wages which were incurred expenses were required to be capitalized in respect of the employees who were working in the site offices, since they were directly involved in the various activities leading to construction of the project. With respect to salaries and wages in respect of production departments from serial numbers 1 to 10 till IT infrastructure in the corporate office were required to be capitalized, since these employees were working in departments exclusively performing the activities relating to construction and execution of the project. The company also contended that salaries and wages of employees in finance department are mainly involved in carrying out the responsibilities relating to project implementation, such as evaluation of bids and processing of payments. And therefore, these should also be capitalized because they are primarily working for the project itself. The managing director and the functional directors who are there the expenses on those should also be capitalized, since they were also involved mostly in overseeing the project execution. The contention of the company was that since revenues have not commenced and the company is engaged only in the construction, so even the directors are also completely occupied in overseeing the capitalization in the construction activity. So the next indirect expenses is with respect to traveling expenses. Again, the traveling expenses were accounted in the manner similar to how salaries and wages are. And what the company contended was that these traveling was incurred on inspection of materials, site visits, or maybe attending trainings and workshops which were held for project execution. And therefore, these traveling expenses are directly, the company's contention was attributable to the construction of project execution, and hence these should be capitalized as part of the project. Legal and professional fees incurred on lawyers and fee for project public relations consultant. The company's contention was that these fees paid to lawyers for making appearance before the courts, etc., were for removing various hazards that come in the way of construction, such as arbitration matters, such as contractor disputes, commercial disputes, and therefore these are again attributable to the project in progress. With respect to public relations, the company was again of the view that this was integral to the project which was being constructed, and therefore the engagement of a PR agency was required because being a massive project, they had to interact with a lot of stakeholders, including the public, to ensure that the project is pulled off successfully. And therefore, there was a lot of engagement with the stakeholders, including the public and government and different agencies. And the benefits of the project had to be explained by the PR consultant. And therefore, since these expenses again relate to the project in under construction, were required to be capitalized in view of the company. Fee to tax consultants, again, since these were relevant for custom duties, import, for seeking advices on whether customs duty would be levied or whether GST would be levied or not. These again would, since related to the project GST and project customs duty, was again related to the project, and therefore the company contended that these fees should also be capitalized. With respect to training and books and periodicals, the company contended that this training was integral part of the building of the project, and this training was required to upgrade the skills of the relevant employees to ensure that they again are able to construct the project successfully. So therefore, these training again should be part of the project and hence should be capitalized. Books and periodicals, there were books which were required, which were procured for manuals and were the standards of to maintain the standards, ISO standards or the codes and standards of the project, etc. And therefore, these books and periodicals procured by the company was also required to be capitalized to ensure the quality of the project is maintained. With respect to fees, subscriptions, again, the company contended that these were fees paid to various professional bodies, institutes, and therefore are useful, and therefore these provide useful guidance and for the employees to in the related areas of construction, hence should be capitalized. With respect to annual membership fee, the contention was that of chambers, etc., which are not related, were charged off to revenue according to the company, but other membership fees which are certain, which provide useful literature and seminars and workshops with respect to the construction would be required to be capitalized. So there was a distinction made with respect to fees and subscriptions to clubs like India Habitat Club and to professional bodies or institutes which provide seminars and workshops with respect to the construction. So fees, subscriptions to bodies which provide some guidance with respect to the construction were capitalized. Other memberships were charged off the revenue as by the company. Office rent and office maintenance, again, certain expenses were incurred on common facilities which were directly involved in the construction of the project, and other employees as well, such as office rent and office maintenance. What the company did was it partly capitalized part of the overall cost of the project. So for the sake of convenience, what the company did, what was it allocated the expenses on office rent and office maintenance, the common expenses, in the ratio of area employed by the occupied by the employees engaged in construction activities and employees which are engaged who are engaged in HR, administration, and secretarial activities. However, the expenses incurred for site offices were capitalized as they were entirely engaged in construction activities. With respect to vehicle running and maintenance, the principle that was broadly adopted was similar to how salaries were capitalized. So accordingly, vehicle, etc., provided to employees for discharging the official duties were capitalized to the extent they were incurred at site offices. With respect to employees who were at corporate office, were capitalized to the extent of incurred on employees working at functional departments. In respect of the administration departments, they were charged off to revenue. Expenses incurred on meetings and conferences with various stakeholders in connection with matters relating to construction activities like meeting with contractors, suppliers, government officials were also capitalized as part of the project. So the question that they put forth before the EAC, when we look at these expenses, there's a compelling case by the company that since these were incurred by the company to ensure the project becomes successful, or these expenses would not have been incurred if the project was not there. The argument put forth by the company was that all these expenses should be capitalized as part of the project in progress and as part of capital work in progress, which the project is under in construction. So So the company contended basically that all these expenses are therefore necessary to complete the project. So the question that was put forth was to the committee was whether these expenses can be treated as incurred for the project and therefore can be capitalized as part of the project. So, Jayan sir, I would request you now to take these issues expenses one by one and also discuss the principles of the capitalization which are laid down in Ind AS on property, plant and equipment, and also to some extent also guide us whether these principles would be applicable under the accounting standard framework also. I would just request you to just go a step further to discuss those issues as well. So,
I think it's a big query, very lengthy, so very nicely put through by you. And thank you both the expert advisory committee and the current office bearers for giving me this chance to re-educate myself, if I may say so. Some of these opinions were given, and I'll not repeat what Sandeep said. A whole lot of effort goes in from not only the officials of the institute, the members of the committee. I will simply endorse what Sandeep said at the beginning. I'll go straight to the query because I see we are a little bit behind time. But before I tackle each item by item, I thought it might be more useful to have a quick look at the principles that we are looking at. So just a few thoughts on the principles, and then we will tackle each issue independently. So first and foremost, and this is a lesson because I came from an income tax background and a lot of our colleagues also come from, that means my generation at least was primarily into income tax initially. Now, of course, there are many specialists in audit and accounting. But very often, even for our CA final, we study so much of income tax and direct and indirect tax and so on. We tend to have a hangover of those concepts into our reading of the accounting standards. So let me put first and foremost a broad principle that applies to Ind AS, IGAP, our institute standards everywhere, and of course to IFRS also, that all of these standards are principle based. So the object has to be not to interpret it in a rule based manner, but taking into consideration what is the objective, what is the broad purpose, the purposive intent, if you look at from an interpretation point of view, that is what it is called in income tax, that you have to look at purposive intent rather than the literal intent, okay, or literal wording. The reason why I'm mentioning this is that when we come to this, and I'm going to stress on a couple of words how to interpret these specific provisions that are there, is that one should not try to derive meaning from the language alone and laying emphasis on some particular word here or there, because that is not how the standards are to be interpreted. That is how a tax statute is to be interpreted. In taxation statute, it has been laid down by the Supreme Court also that when you are going to deprive somebody of his hard-earned income, the provisions of law must be absolutely clear. In contrast to that, in accounting standards, when you are going to lay down a principle of disclosure, it is the principle that is more important. And therefore, I would begin this entire answer, even the answers that Sandeep has, not Sandeep, Vivek has put up on the screen right now. They are making a reference to AS 16, and fundamentally, para 16 AS 16 says that the cost of an item of property, plant, equipment comprises. Now, if I look at the interpretative angle, comprises does not mean includes. It means exactly what it says. So that is the first part. And then it goes on to say, amongst other things, subpara D makes a mention that any cost directly attributable to bring the asset into the location and condition necessary for it to be capable of operating in the manner intended by management. Now, the word directly attributable, and this has been the subject matter of considerable debate in various opinions in the EAC, and therefore I am glad that this issue has come up through this query, that when you're looking at directly, the word directly has to be contrasted to, because attributable, of course, encompasses a lot of things. but the word directly is to be distinguished with reference to directly or indirectly. So if I give, without coming to, and there are so many examples, indirectly, everything that every employee does in the company that is the queryist, everything contributes indirectly. Even a sweeper who keeps the office clean, or somebody, the watchman who ensures that the IT systems are safe and secure when everybody is off duty, also contributes to the object of the company. And the object of the company, as it is running just now, is simply to construct the given assets. But whether one can really say that it is directly attributable to bringing the asset into its given location and condition, that is the real crux of the issue. And therefore, I would look at it like this, that undoubtedly the company has tried to expand the, or I would not say attribute any motive to that, but I'm saying that perhaps they have been more influenced by a broader interpretation, which may be taken in other statutes, taxation statutes, etc. But in accounting, taxation has no relevance. Actually, it is the accounting that is preceding, and then only the taxation steps in. And therefore, when we speak of directly, just to give an example, suppose an employee suffers injury while actually constructing the capital asset. He is hospitalized. He is thereafter, the company says, okay, we don't want to affect the morale of the employees. So not only they bear the hospital expense, they bear expenses to transport him to his hometown, let us say in UP. From Delhi, he is sent to UP. Perhaps if he is not recovering well or he is seriously injured, the site manager also visits or accompanies him to that place. They take the company car or some ambulance over there. Are these expenses essential? I would say certainly yes, because the company needs to show its employees and demonstrate to them that we care for you and the work should not be slow, etc. But you should continue working. We will take care of you otherwise. That is a very genuine and noble intent. Does it directly contribute to the construction of the asset that is being constructed? The answer is clearly no. So that is the litmus test, which is fairly simple. That does it directly contribute to it or does it indirectly contribute to it? And therefore, the test would be that where is it contributing directly? So let's take the specific examples. Keeping this, and in taking all these situations, keep in mind that one has to go with a purposive interpretation that what is direct and what is indirect. And therefore, one, when looking at it, one must see what is it that you're going to capitalize. So whatever is adding, employees who are contributing, workers, laborers, engineers, that has been mentioned in the query, whether that should be capitalized, certainly yes. If the employees employing at the site office are there, and that's why we have sort of tabulated the answer in that sense, that if they are at construction activity at site office, including the costs of site office, which will come later, these costs could certainly be capitalized. Of course, as has been rightly mentioned, you have to have adequate record to justify such capitalization. Cost of employees working at the other departments, especially finance, HR, administration, company secretary, do they contribute? Certainly every employee contributes. They are part of the team. Do they contribute directly? The answer is no. And therefore, the EAC rightly pointed out that cost of employees in other departments such as finance. Now, if you don't have finance, you can't bring in the asset into existence. But does it contribute directly? The answer is clearly no, and therefore that cannot be capitalized. So that is the way that one has to, rather than look at what answer the EAC has given, it is actually more often more educative and instructive to see what is the underlying logic that goes into it. Similarly, managing director, director of finance are involved in overall supervision, etc. Therefore, their cost should ordinarily not be capitalized, is what has been mentioned. And I entirely would suggest that that is the approach that is appropriate. And of course, EAC having said that, it is binding, at least on the company concerned. But when you are faced with this problem, you must test it that, of course, the managing director brings a lot of experience. But let's say the managing director is a very highly qualified civil engineer himself. He is himself participating in the design methodology, etc. then perhaps there is a case that one can look at it. But unless there is a direct involvement of the top management is taken as persons who are only contributing indirectly, and therefore, unless it can be demonstrated that they are directly related to the work of construction, it would not normally, including the director, managing director, who could be an engineer also. But if he is looking, very often the managing director of a company is looking after so many other areas, such as liaising with the ministry, with the bank officials, and seeing that all deadlines are being met, monitoring performance, and so on, that it does not directly contribute to the construction activity that is carried on. On the other hand, if there are certain functional directors who are contributing, yes, that could certainly be capitalized. Similarly, coming to traveling expenses, without getting in, now that I have enunciated the principle that has been considered, if there is a direct cost of visiting a construction site, or but then if you're incurring a traveling cost to attend workshops, training, of course, has been specifically mentioned in the standard itself, in the illustration that are given. But let's say you are going to a cement plant to examine the quality of cement before it is dispatched. Undoubtedly, quality of cement is important, but is it directly resulting in the construction activity? Answer is no. So by and large, traveling costs, unless actually demonstrated to be contributing to the construction activity, should not be capitalized. So the the responsibility of showing and documenting that these are directly attributable to the capitalization, directly attributable to creation of the asset and bringing it into a workable condition. Expenses like traveling costs, legal and professional fees, again, I'll not go into detail, but these cannot generally be considered directly attributable. And therefore, that is the stand that EAC has taken, not only in this opinion, but in numerous other opinions also, where this sort of a issue came. The word directly attributable has been often considered in a similar manner. So also training, of course, para 19C has been cited in the slide put up by Vivek. Para 19C itself specifically says that cost of training, etc., cannot be capitalized. So also the other costs that have been mentioned by him, that the costs related to the books and periodicals. Like if you say that you want to decide on Ind AS, for example, surely you need to know what Ind AS is, or what Indian GAAP is. The question is, can you say that it's directly contributing to my signing of a particular balance sheet? No. It contributes to my carrying on the profession generally. So similarly, if I am studying something in regard to construction standards, or I'm saying what is the strength of material that has to be utilized, etc., these are general reference books. Of course, company itself will not capitalize general books, newspapers, non-technical. But even on the standards related books, etc., or books which are by way of subscription, just like our CA journal is, the Engineering Institute brings out certain publications and so on, or guidance notes, just as we have. All of that would not be capitalized because it is not direct. Same principle in fee and subscription. In office rent and maintenance, I'll go slightly more in there because they have themselves recognized that certain part does not relate to direct costs. However, even the methodology that they have taken in terms of area may not necessarily, I'm not saying that they are wrong, and I don't think the institute also has taken a view, because that is, EAC has not taken a view on the methodology, for the reason that, as I mentioned at the beginning, in a principle-based standard, it is the facts and circumstances that would guide the auditor and the CNAG to take a correct call. One cannot be prescriptive. We are not rule-based, as is sometimes the US GAAP is. Sometimes they say that you take 70%, 30%, whatever. But we are not prescriptive in our standards, and therefore we will not say that. Can it be area? Yes. Can it be number of persons employed? That could be another option. Can it be the overall budgetary cost as shown in the original project report? possible. So there are different bases of taking this into consideration. I would not want to say that one is correct or the other is right, but surely what is not directly attributable needs to be excluded. I think considering the time that we are running at, I'll not get into the detail of vehicle running. Same principle applies. Meetings and conferences certainly not capitalizable. So I think one should simply leave it at that. Keep in mind these principles, don't be affected by income tax principles, don't be affected by what is going to be the benefit to the company when deciding on accounting standard issues. Stick purely to that, and I think you will come to the correct conclusion. I think that's more or less it.
Thank you, Jain sir. I think you put forth the principles very lucidly and described each of the expenses very well. One question, Sandeep ji, that I would probably ask you here: how strong is the test of direct? There are two words which are used in this para, which Jain sir pointed out. One is directly attributable, and the other is necessary. So, any cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating. How would you, just explain the tests of directly attributable and necessary? Could you just, explain a bit more? I think that would be relevant.
So I'll only take this from one significant example between the earlier accounting standard and the Ind AS, between what is necessary. So not directly attributable, but what is necessary to bring the asset to its use. And this was a classic example where you are constructing a power plant or a location on hilly regions, and you have to rebuild or strengthen the passes which goes by, because you may have assets which may be weighing 100 tons, 200 tons. Sometimes you have to widen it because they are over-dimensional cargo. And those are not your assets. Those are owned by the municipality or the Gram Panchayat or state government, or it can be running through a private property. And the question is that for you, for the vehicle to pass through, those would have to be spent. And the question which was coming classically between the earlier, if one goes by the earlier our standard and the Ind AS standard, the question was that whether is it necessary for me to bring, and if I do not spend this expenditure, then it cannot, asset also cannot come into existence. So the principle, particularly in the areas which are corporate in nature, is where the biggest item comes in. On the aspect of attributable, because these tests are always seen through. You have CFS where you are, approach roads have to be built in. Now the question is, those are not the assets controlled by you, because they are not within your areas. And therefore, the principle for deciding the standard, whether will you move that it is not directly attributable, but it is necessary to construct. And if I were not to have that expenditure, could I still have had the asset? Because I can theoretically have 15 people in my finance team, only because they are, and that's what Mr. Gokhale was also trying to say, that only because you have an expenditure under construction company does not mean that everything is connected and necessary for bringing the asset. And I may just want to, therefore, only on one part, I may just want to say that when he was talking about traveling, the other examples which generally comes through is when you have the QC hold point, because in many capital goods industry, before the next step of the asset is put under construction or under assembly, the earlier tests are necessary to be quality approved. And it may be through a company's own executives, it can be through a third-party quality controller. And those are some of the questions which are coming in, that whether they are directly or again they are necessary. Because if finally if the asset has to perform to what it is supposed to perform, and those are your hold points, so there can be very strong arguments. I think I can imagine as auditors, this is an area of tug of war, and our principal knowledge has to be extremely strong in terms of saying possible, not possible. Because what is possible, there is never an argument. What is not possible will generally flow from the standard. The question is what will be capitalized and what will not be capitalized as a percentage allocation, which is where the whole principle comes in. That's where the whole knowledge on the standard, and that's where some of this EAC principle, in my opinion, comes extremely handy for the professionals to, be able to, qualitatively examine the issue in front of them.
Thank you, sir. Thank you, sir. I think one important takeaway which Jain sir also pointed out, when we read through the Ind AS and accounting standards, I think we should have to remove the Income Tax Act. Yeah. That is something we always...
Vivek, if I may interject, I was just getting reminded of one tribunal decision in case of a doctor who was living on a 5th floor and heart surgeon. And the question was that his elevator in the building had to be replaced. Otherwise, his profession was under challenge. Either he and the question was whether is it an expenditure, business expenditure connected with my profession or not. So this is and I rightfully, we leave few things to the for the judges and the tax practitioners, and something we will leave at our level. Yes, please. Forward.
I think very interesting discussions on capitalization. Just one disclaimer here, these expert advisory committee opinions are based on specific facts of the particular company. So again, we should be very careful when we read through this opinion. These serves as important guidance when we look at the principles which are being given. But of course, you cannot, this is not a straitjacket formula wherein you can apply these principles across every company. We need to look at each and every query and facts differently. Coming to the next facts of the case, I think this is again a very interesting issue that we may face practically, wherein how the treatment would be in a standalone financial statements vis-a-vis consolidated financial statements with respect to accounting of impairment and reversal of impairment loss at standalone level and at consolidated level. So this again will give us important insights as to how we should approach an accounting issue when we look at standalone financial statements, and how we should approach an issue when we are looking at a consolidated financial statement level. Coming to these facts, so the company which is engaged in exploration and production of an oil and gas industry is operating overseas projects also, and which are generally operated through subsidiaries by participation in either joint arrangements or in investments in associates. So what the company did was it had acquired 60% shares in an overseas company, which was having a participating interest in an overseas oil and gas project. So let us take an example where the company has acquired a subsidiary by investing in 60% shares of that entity. That subsidiary had certain assets in the form of participating interest of an oil and gas project. What the company did was, in the standalone financial statements, the purchase consideration which was paid for acquiring those 60% shares was accounted for as an investment in the subsidiary company X. Now, the purchase consideration which was paid for acquiring 60% was higher than the proportionate net assets of the subcompany X on the effective date of acquisition. So what it did was it recognized the difference between the purchase consideration paid and the proportionate net assets as goodwill on business arising on business combination in the consolidated financial statements. So the net asset, so we consolidate on a line by line basis when we prepare consolidated financial statements. So when we prepare the consolidated financial statements on the amount, since it was paid, which was higher than the net assets of the company X, the differential amount was treated as a goodwill in the financial statements of the in the CFS of the company. The investment in the subsidiary company was continued to be recognized at cost, and this included the proportionate net assets of the subsidiary company plus the amount paid towards the goodwill. So the 60% paid as purchase consideration was continued to be accounted at the standalone level. Subsequently, post-acquisition, what the company did was it carried out an impairment assessment. Now, this impairment assessment, when you recognize goodwill, is required to be carried out annually with respect to the cash generating unit of the subsidiary company. So what the company did was, when it carried out an impairment testing for the CGU of the subsidiary company as well as the investments in the subsidiary company from a standalone perspective, the when the value of the goodwill was added to the carrying value of the assets of the subsidiary X in accordance with the requirements of Ind AS 36 para 80. So the impairment testing has to be looked at vis-a-vis the amount of investment made from the perspective of from a standalone level, and from the perspective of CFS level, it has to be looked at the net assets plus the goodwill, which was required to be added to the carrying value of the assets of subsidiary X to understand whether an impairment provision was required. So the company, when it assessed, it recognized an impairment loss against the associated goodwill in accordance with para 104 of Ind AS 36. So there was an impairment loss which was required to be recognized when the company did a CGU impairment testing, and that impairment was recognized against the goodwill which was recognized at the CFS level. The company also recognized the impairment loss at the standalone level because the company considered it as a permanent decline in the value of the underlying assets. And therefore, since the impairment was recognized against goodwill at the CFS level, that impairment was also recognized at the standalone level against the investments which were made. What happened subsequently after 3 to 4 years, again when the assessment was made, the company assessed that the recoverable amount of the CGU has now become higher because the oil and gas interest, the participating interest was there, but had become more valuable. Now, as per the principles of Ind AS 36, if you are recognizing an impairment against goodwill, you cannot make a reversal of the impairment loss in the consolidated financial statement. So this is as per the requirement of Ind AS. What it's basically the principle that is there is, if you have recognized an impairment against goodwill once, you cannot reverse it because that would tantamount to recognition of internally generated goodwill, and therefore that is not permitted to be reversed when an impairment provision is made against goodwill in earlier year, and therefore even the value of the CGU, if it becomes higher, you are not allowed to reverse the good impairment which has been recognized earlier. What the company contended that in the standalone financial statements, since it is totally linked with how the CFS is presented, and therefore the impairment loss was not reversed at the standalone level also. The company contended that since if the impairment loss is not permitted to be reversed at the consolidated level, that impairment loss which was recognized at the standalone level can also not be reversed, and therefore the impairment loss charged against investment in subsidiary was not reversed in the standalone financial statements of the company. So what the company tried to do was contended that since at the CFS level the goodwill is not allowed to be reversed, even though the CGO value is now higher, at the standalone level also the impairment loss which was recognized against the value of the investments of the subsidiary was not reversed, citing Ind AS 36, saying that if there has been an impairment of goodwill once recognized, you cannot reverse it. And since at the standalone level, this represents nothing but the net assets of the subsidiary recognized as part of the consolidated financial statements, this cannot be reversed at the standalone level as well. The question put forth before the committee was whether it is appropriate in accordance with the principles of Ind AS 36 that if a company has not reversed its impairment loss cannot reverse impairment loss at the consolidated financial statements level, is the company therefore not permitted to reverse the impairment loss also at the standalone level due to permanent decline in the underlying assets against the associated goodwill that cannot be reversed subsequently? So this was the question that was put forth before the committee, because this was an issue that they faced at the time when the audit was being undertaken. The question was whether, if at a CFS level, a goodwill is not allowed to be reversed, whether goodwill whether the investments at the standalone level also need to be looked at with those glasses similar to how CFS is looked at, or would it be looked at differently? So I would request Sandeep ji to put his views on this issue. I think this is very, very relevant when we prepare standalone financial statements and consolidated financial statements, and how we look at the two financial statements from a same lens or differently.
Absolutely, Vivek. Relevant because in our case, SFS is also as important as the CFS. For all those readers whose ears did not pop out when they read about the query permanent decline, and all of us have lived through the AS 13 era, where accounting policies would always say that you provide for the impairment provided there is a permanent decline, and institute in every of its advisory come back and say, please read, it says diminution other than temporary, and so EAC has very clearly also because you can't rephrase the query, so the EAC has certainly brought it out as a first part of its answer that we are not happy with the word permanent decline as a part of the choice of terminology, and to that extent I can tell you why the EAC looks through every word with a magnifying glass. Just to share the the thoughts. The second part, as Eva always, that each of these queries brings out a dimension, and therefore quickly the other area which it has brought out is that one should look at the functional currency, because it is possible that the functional currency in the given facts may not be the reporting currency which may have been there. So that's another dimension which the EAC is saying that look, we are not examining that, but that's for the learners this becomes another important aspect. The third aspect, because we have investments in amount and the goodwill in the dollars, we are not able to, from the facts, we are not able to make out that whether that impairment at the CFS level, whether represented 100% of the goodwill or it represented portion of the goodwill, because the first impairment was done in 2016 and the reversal was done in 2020. Assuming that there was balanced goodwill left, then the impairment testing had to be done year on year, because that's a mandatory standard. You don't look for indicators, but if there is a carrying value of goodwill, you have no choice but to do impairment testing on a year on year basis. That's the third part, which is important, just so that we have our facts in our place. The question which is arising is that whether the terminology under Ind AS 36, which Vivek rightfully came back and said that while there is an explicit provision that if there is a impairment provision of goodwill, then your para 124 says that you will not reverse in the subsequent period, and the analogy which Vivek gave is right, that thereafter it actually became an internally generated, because you worked upon that asset, and therefore you are not able to say that it was only because of what you acquired at business combination is what you are reversing, because that's and very rightly he has given the insight as to why the 124 says that you will not reverse, because that is to tag along under your both the aspects. And so therefore what is it that there is no denial of the fact that at a CFS level your goodwill was there, it was impaired. Logically, if you're in a parent, if the subsidiaries underlying assets are impaired, you also have to obviously relook at, because you bought something for X amount, and then within that X amount, assuming that it was 1-to-1 parallel, and then there was a goodwill which you impaired. Of course, your investment in the financial instrument, while you do carry forward your investment in subsidiaries at cost, because that's one of the choices which is there, but that does not mean that at cost means that you do not impair it. So you still will apply the principles of impairment standard. Now the question which was against and what was considered, and then what was the final opinion. The discussion amongst the querist and the auditors and the related professional was that whether the goodwill which is sitting as in my consolidated financial statements and the goodwill which is sitting in my cost of shares in my standalone financial statements, whether both of them remain equal. And therefore, if I say that I cannot reverse the asset, whether does it necessarily mean that I cannot reverse the impairment in my standalone financial statements? standalone financial statement, because what I am going to restore is also element of the value. Now, while the impairment standards apply in both the cases, but when it comes to the reversal, when it comes to the Ind AS both 27 and 36, the reversal or a reassessment of value in the standalone is not only on arising out of the goodwill. It is one of the indicators which has resulted. Obviously, you cannot take it above cost because that's your ceiling part. But the overall assessment of the shares is where the reversal will come in, and therefore the answer which was considered by the EAC, and one more thing which was brought out to the attention of the EAC, and therefore always EAC is always in a situation where there will be material which are released by the ASB, and therefore one of the question which was also pointed out for EAC for its consideration was the question was on the educational material on Ind AS 27, which is on standalone. And when we read that question and we look at that answer, neither the educational material says that it does not prohibit or disallow recognition of reversal of previously recognized impairment loss in a separate financial statements. So what was happening was that it was being read little differently from the manner in which the query was there and the manner in which the reply was there. So the answer, considering the principles of goodwill for the purposes of a standalone asset versus the carrying value of the shares, because what you are valuing is the financial instrument, and therefore both do not partake the same characteristics, and therefore the prohibition which is there under 124 is not the principle which you will apply when you are restoring the carrying cost of your investment in the subsidiary to its original cost of acquisition, because now you are saying that the impairment conditions no longer survive. That is the part of the answer. I would also specifically say that because this was in a transitionary mode as well, so there was 101 implication had to be seen, and the question here would be that whether this this non-reversal of the provision for impairment and not provision for goodwill in standalone financial statement, it is the impairment of your financial instrument. In console, it's a provision for impairment for goodwill. These are two different terminologies, and therefore the standard required the standalone financial statements to reverse the impairment provision which it did, and therefore the view which had to be also provided to the EAC to the question whether does this result into an accounting error, and therefore your para 42 of restatement will kick in, and the answer is that and appropriately it would have to be done. So this is and this we are facing this in multiple cases, Vivek, that this is an extremely important principle to know that that between an SFS and CFS and what constitutes the component, they too cannot be read unless the standard specifically asks you to read through. So that's the very nicely the EAC has opined that the standalone financial statement should have reversed, and the para 42 of Ind AS 8 on the restatement should have been should properly be applied for.
Thank you, Sandeep ji. Sir, Jain sir, any quick thoughts on this particular issue which you may just want to highlight?
No, I think just in a word, I'll simply say, because now it is no longer so important, the principle of conservatism underlies all of this. So if one really looks at it, of course, one has to read the standards in that context, both in terms of standalone and in consolidation. But the reason why basically these provisions are made in the standard also needs to be understood, that one cannot be writing back something unless one has reached a position of certainty, and therefore the standard is proceeding along the lines that it has done, and that is why the answer is given by the EAC. I think I'll limit myself to that because there are so many facets to each question that one can discuss for a couple of hours every issue, but we'll refrain from doing that right now. Thank you.
Thank you, Jain sir. I think very good insights made by Sandeep ji and Jain ji both. One important point, I think, as a takeaway that we should understand from this query is when we look at standalone financial statements, we look at only standalone financial statements. And when we look at CFS, we look at CFS entire group as one entity. That is how we look at it. And in this example has actually very beautifully brought out the differentiation between impairment of a financial in asset, which is equal to investment as one asset. And when you look at impairment of goodwill as part of one of the assets sitting in consolidated financial statements. So you cannot mix both the principles which are there. Impairment of investments made in subsidiaries, associates, joint ventures, although covered within the purview of Ind AS 36, although covered within the scope, you cannot equate it with the impairment of goodwill lying as one of the assets in consolidated financial statements, because the principles of assessment of impairment is also different when you look at it from a standalone perspective, when you look at it from a CFS perspective. It's from a standalone perspective and a CFS perspective, the level of cash generating unit may be different. There could be some intra-group transactions which need to be evaluated. There could be some business synergies which could arise outside the subsidiary or group. And so there could be different principles which arise. And therefore, we have to look at each of those financial statements differently and understand the principles in a more of a substance rather than just looking at each of the standards. Thank you for bringing out this insight, Sandeep ji. Now we'll come to the fourth case study. This is again an interesting case study on leases. I think we always have issues when we look at how leases need to be accounted for. And this one example, I think, brings out the entire principles of identification of a lease very beautifully in one opinion. So what I will just discuss in brief the facts of the case. So basically, this company is in the business of city gas distributions. As part of its operations for laying down city gas this network, it entered into a way leave agreement. So way leave agreement is nothing but a permission from the railways to grant leave grant leave for a passage for establishment of a pipeline for gas distribution. So basically, it's an underground passage, that is, a right of underground passage is granted by the Indian Railways below the rails to allow the city gas distribution to distribute the gas as part of its business. So the railways was allowing limited use of its land for a specified purpose, like access to passage, etc., for laying down underground pipelines. So the company had to enter into these agreements, way leave agreements, or permission these agreements for 10 years by paying an upfront payment. So we had to pay the upfront payment for the entire 10 years. And there was a permission to use an underground space, which was explicitly specified in the contract agreement. So this is very important. So the use of the underground space was explicitly specified in the contract. The company was granted a way leave facility to lay the pipeline across the land, and the entire cost of setting up of the pipeline was with the company, and the maintenance also of the pipeline was to be maintained and renewed by the company only. The land ownership continued with the railways, and therefore the company was permitted only to use the land for laying the pipeline. You were not entitled to the ownership or the legal ownership of the land in any circumstance. The company was also not permitted to transfer or sublet the privilege granted by the way leave facility. So the company there were specific terms and conditions which were specified, and the company was therefore specifically, as per the agreement, was not permitted to transfer or sublet the privilege which was granted by the railways. And it could only be used for the specific purpose which was indicated in the agreement. Now, in the event railways were required to execute new works on the land on which permission was given, the and which required therefore the shifting of the leave facility which was granted to the gas distribution company. The gas distribution company would have to agree to carry out these alteration or shifting at its own cost. So even if there was a shifting which was required, if the railways required because of some new projects which were executed by the railways to shift the wayleaf shift the wayleaf facility, the company, the lessee or the grantee was required to carry out this alteration or shifting at its own cost. What the company did was, before introduction of Ind AS 116, it used to classify these way leave charges as prepaid expenses, and then these prepaid expenses would be amortized over the period of 10 years over the life of the agreement. During the audit of financial year 1920 by the government audit, it was opined that this treatment of way leave was not correct, as the company gets a right of use of the underlying assets, and therefore this right should be reflected as ROU asset in the financial statement in accordance with Ind AS 116. However, again in financial year 2021, the company, what it did was, on the basis of the observation of the audit in 1920, it actually went ahead and reclassified the prepaid expenses as right of use assets in the financial statements. However, during 2021, the opinion was that the company only has a right to lay the underground pipeline and not the actual land with it. And therefore, it probably said that it is not an identifiable asset in accordance with the principles of the standard on leases. And therefore, this should be reclassified as these prepayments should be classified as intangible assets under Ind AS 38. So the question which was put forth before the committee was whether these prepayments would be classified as right of use asset, or should be classified as intangible asset under Ind AS 38, or should be classified as prepaid expenses under other non-current assets. The company also went on to ask the question whether there could be any other accounting treatment which is possible, to understand whether, if it does not fit in any of the three clauses, how would it actually classify these permission which was being granted. So, sir, Jayan sir, I would actually request you to take the audience through the nuances of the lease standards and actually discuss about how the lease is identified, whether it would meet the ROU asset, whether it would meet the intangible asset criteria. How would you actually deal with this query if on a practical basis this query would come to you? EAC has dealt with it, but I think the thought process behind, understanding this query is very, very relevant.
Of course, while one would love, having spent so many years in the profession, one would love to go through the entire niceties of the issue, which the EAC does actually when we, when we really sort of look at these issues as we deal with them. But looking at the constraints of time, I'll try to focus on some of the important issues rather than go into that sort of a detail. But let me put it really in a practical sense, that this is at least what all of us experience, and I'm sure when practicing, that it is not a question of a multiple choice question that either A or B, it can be any of the others. So when you come to that any of the others, you have to really rack your brain to see that, is it a lease, is it a right of use, is it a prepaid expense? So all the options are open when you are considering this. The important part, again, as I look at it, and in this specific query that I look at, the first and foremost issue that was to be addressed is that how do you classify this payment that has been made? There is no dispute, and there are certain facts which are undisputed, that it has been made, it is made for 10 years, therefore way lease charges, you're getting rights underneath the ground and so on. And legal ownership rests with the railway. Now, these are the given facts which are undisputed. No right to transfer, you have rightly brought out those facts. There are also certain controls, but that is what actually creates the problem. Railways has put in some of the points saying that you cannot use it for other purposes other than what it was granted for. So, for example, if the gas company says tomorrow we have got a subsidiary which is now dealing in oil, so I'm going to put another pipeline along with that within the same space, I'm going to put in, say, something for oil or maybe a fiber optic cable, would it be permitted? answer is strictly no, they would have to go back to the railways and say it's not causing you any harm. Why don't you allow me to put a fiber optic cable for a leased line, for example? But the condition is that you cannot use it for anything other than what it has been permitted for. And therefore, this factor will play an important part in the analysis of how we come to an answer of that. So the first issue is in the classification. Does it fall as a lease, or that means a right to use an asset, or is it an intangible asset? That is, I think, the primary query that one has to address. Now, while one is addressing that, there is no, although lease standards gives, and I will make a mention of some of those paras, lease standards give certain tests as to what are to be evaluated. One has to also understand with some degree of clarity, and at times it becomes necessary to take support of a technical person also in order to understand that. But EAC in this case, we have gone through the details. They have understood that it is not just the something that is a right that has been granted. There is a tangible asset because of certain defined space. You can't say I'm laying down a pipe. That pipe could be 3 meters in diameter or 30 meters in diameter. No, that option is not there. There is a specification in the underlying contract. If the viewers were to see the details that are given in the query, which obviously you can't put up everything over here. So there is a certain space that is given. Now that gives it some tangible form. So when you are classifying it, and also one has to read the language of the standard. So when you see the standard, and the committee has rightly pointed out that initially the lease standard itself says that company should consider the requirements of lease standard, and only if that is not applicable, then one goes to Ind AS 38, that is intangible assets, etc. However, does it fall within the criteria of lease assets? The EAC has considered, and rightly so, yes, it does fall under lease assets. And if it applies to a right of use, then does it fall within the exceptions? There are certain exceptions provided in Ind AS 116 itself, para 3 and 4, EAC has made a reference, that an entity will use this standard for all items where there is a right of use in a, whether it's in a lease or a sublease, unless the rights held under a licensing agreement, etc., are in regard to an intangible asset. Now, that is an exception carved out. Therefore, one is again thrown back to the question, are you falling within the exception carved out for intangible asset? So really the question to be decided is basically tangible asset, intangible asset, and then taking a view of the facts of the case, as I mentioned earlier, that these items have been mentioned in the agreement, that there is a particular space given to you, space in the sense, not space in abstract, a particular volume of area that you are allowed to go under the ground and put a pipe through that, which can carry your gas through that. That is right. That is the right that has been given to the person. So that way rights have been given for that purpose. And therefore, once you come to that concept that it is not something intangible, you can actually have that space. If you don't use that space, the land, the earth is still there. And therefore, the conclusion that is reached is that it is a tangible asset. So once the right is to a tangible asset, then that exception of AS 38 actually. I think some voices. Okay. Perhaps somebody has switched on a second microphone in one of the places. That echo is coming. At least I'm getting that. Yeah.
Now it's going. Please go on, Jay.
Yeah. Okay.
Sir, you're muted, sir. Sir, you're muted, sir. Could you just unmute your...
So, I don't know, that muting happened automatically through the system. But anyway, I hope it's not a signal that I should end, but anyway, let me complete this. So the point was that once it is decided that it's a tangible asset, then the question of moving to AS38 actually does not arise at all, because it is the specifically provided in Ind AS 118 that that is how it would have to be. So having considered all this, one particular point I would also like to draw attention, and I made reference to that very briefly, that while the railway has kept certain reservations on the use and certain what has been mentioned as protective rights, it is a matter of very carefully examining that there are sometimes rights that are restricted, which would give the impression that actually the physical asset is not really vested in you. That means, can you say that because railway can say that they will, if they have some construction, they will actually take over that space again. You are required to redo the pipes at some different location under a different area, etc. Can it be said that therefore I don't have a right to that area? That the EAC has very carefully clarified, and I think this is a point to note, that sometimes some rights are put by way of a legal protection. These are protective rights, but they are not substantive rights in the sense that neither party to the contract expects that tomorrow after you have put in your pipe, the railway is going to say that no, now you take out 1 kilometer of your pipe, because you can't have a pipe that is not connected for 1 kilometer. So practically the parties to the contract are putting in such a right only in the extreme situation that tomorrow if some technology changes, railways has to go below the ground, they may require you to do this. But these are all more in the sense of protective rights. So that should not influence your decision as to whether the asset is tangible or intangible. And that once you take the larger picture into consideration, the conclusion that has been reached is that it is clearly a tangible asset. Once it's a tangible asset, lease standard applies. Once lease standard applies, then all the consequences follow, that you will account for it as a right to use, you will amortize it in accordance with the uh, requirements of the lease standard and so on. I'll not get into the other details on that, but I would just want to raise one conclusion. That means I'm fully what the EAC has said. I think just to quickly have a look at what the EAC said in conclusion, they have said, they have said that yes, they have said that yes, it is clearly a right to use, and the arrangement which contains the lease, the question of applying other standard does not apply. One issue that has not been clearly dealt with, perhaps because that has not been asked, so to say, they only asked for different methods of options of how you could otherwise account for it. But the fact remains, and which interested me really when I was studying this case, that in the past they have accounted for it as a prepaid expense. Now, as I gather, there can be certain issues, and I'm just mentioning this because the previous query also Sandeep rightly answered that there will be issues about prior period expenses that have been brought out in those facts. But here, a prepaid expense would have been accounted for possibly at face value or at certain discounted value, but it would not be the same as is prescribed under the lease standard. So in the given facts, the company has accounted for that asset and amortized, or they have treated as prepaid expense, and they have straight lined it probably over the period. But the net present value, if it has been considered, whether it is parallel to that which would be arrived at on the basis of application now of the lease standard, and whether the differential, it may or may not be material. So if it is not material, it would not result in a prior period error which requires revision of the earlier statements. But in the rare possibility that it is shifting from prepaid to a lease asset, which results in a change in the carrying value, because by now, let's say 10 years, we are amortizing 100 crores asset, you would have written off, say, 10 crores in 3 years, so 30 crores written off. At that 70 crores point of view, if your lease asset value based on your methodology for determination of carrying value of the lease and your booking of amortization, if there is a substantial deviation which is material to the company in an overall sense, then only the issue of rectification of a prior error would come in. Hopefully, it may not be that material, and therefore that issue has not been raised either by the querist, and therefore, as is the principle followed by EAC, we generally do not volunteer opinions on issues that are not asked. Perhaps it is already clear in their mind, and therefore it has not been addressed. But I thought that listeners may just consider this aspect, that when you are changing from a prepaid asset to a leased asset, this aspect also needs to be taken into consideration. I think that's all that I would have to bring in on this.
Thank you, sir. Sandeep ji, again, a very quick summary or perspective on this particular issue.
So I think Jayant has very rightly said, and I can only say one thing, that all this peaceful opinion, what it does is it gives you a very insightful into the manner in which such industries run, whether it is in a gas or pipeline or the telecoms, because these are fundamental principles of understanding that a landlord versus a licensee, whether only because a landlord has a right to access, ingress and egress at any point of time does not mean that he's going to break open the lock and say, tomorrow morning I will go and come and occupy. But yes, he, in the eventuality when the matter comes in for the legal recourse, then they should have had the rights. So I think very well summarized, and that's the key takeaway, that industry experience comes in very, very handy in terms of both the finer nuances and the treatment.
Thank you, Sandeep ji, for your remarks. Again, we have been able to just cover 4 out of 6 opinions, as was the earlier EAC webinar which was covered. I think wonderfully summarized by Jayant ji and Sandeep ji, both with respect to the 4 issues which are there. Just to discuss this question for takeaway, I think the way, if you read this opinion, I think the way it has been put across and summarily put by Jayant sir, it has been very beautifully discussed in the written part of the opinion, wherein each part of the lease standards has been evaluated, and how this is particular way leave arrangements on a fact basis. It was appearing that this could possibly not be a lease, but when the opinion came out and when you look at the entire opinion, the discussion on each of the line items in the Ind AS 116 has been discussed and clarified how this is an identifiable asset, how the direct to use is there, how the right to obtain the economic benefits is there, why is there no substantive right to substitute the asset. I think all these issues have been discussed as part of the EAC opinion, and it is actually a treat to read this opinion to understand the lease standard. With this, I will hand over the session to Piyush Bhai for his closing remarks.
Thank you very much, Vivek ji, for wonderful moderation. My thank you to Jayant Gokhale ji and Sandeep Bhai. Jayant Bhai, of course, I could not see you in the opening. I think there was some tech issue when we were discussing your profile about it. Of course, yesterday we had discussed that I believe the way experts are there, and to clarify this on an average in 15 minutes or 20 minutes, a particular opinion is quite difficult. But wonderfully it has been done. I think so a lot of doubts would have been cleared of the participants, because only by reading an opinion, the logic behind it, why this was done in a particular manner, what was the thought process actually comes in this particular discussion. You all are aware that Jayant Bhai, Vivek ji, Sandeep ji, all have been part of expert advisory. When we start, we have a very different mindset. We believe that opinion cannot be like particular this. But when we discuss threadbare, and when the different opinions keep on coming, then we realize that how it has happened. I'd request the participants also, while the discussion was going on in the facts, if they would actually really thought process virtually what is happening, how the, let's take an example of the lease, how the rebels would be happening, how they are functioning, practically what is happening. I believe they will form a different opinion. But when you actually read what experts are saying, it actually changes our mind definitely, completely. And that is the best part, I believe, of it. Thank you very much. In the end, thank you very much, Jayant Bhai, for your time. This was our first webinar for the committee year of 23-24. Thank you very much, Sandeep Bhai, for giving your time, for being here with after a minor, if you had some small surgery also.
last week had been very taxing for you. I know I am there. But thank you very much, Vivek. Wonderful moderation, moderating two important panelists, such as senior experts of advisory committee itself is a difficult job, but you have done it very wonderful. So thank you very much. I would also thank all the participants for their patience. My request to participants, please keep on watching for this particular space. We'll be coming with more. We could only complete 4 opinions today. We had in mind total 6 opinions, but please we'll come with discussion on another 2 opinions, and we may add further opinions also very soon. So please keep watching our space and our material, or whatever EAC will release it. Please look into it, and also please reading. Now, my small request before I part with it: these 4 opinions which have been published in journal also, please read it now. There would be totally different perspective. You would have read earlier. Now we have heard the experts. Now you read it. It would be totally different exposure. I'm telling you. And in fact, for my view has completely changed. I may have not agreed with that EAC opinion earlier, but after listening to Jain and Sandeep, I think so. EAC opinion was correct, it seems. So thank you very much once again. Thank you. Good evening, participants. Good night, everyone. Thank you. Tech team, please stop the recording, and we can end it.
Okay, thank you. We leave.
Thank you.
Yeah, we all. Thank you.
Okay, thank you.
Thank you.
Recording stopped.